Imagine this: one of the largest pension funds in Canada, responsible for securing the financial futures of countless retirees, managed to grow by only a modest 1% after being hit hard by currency fluctuations. It's a situation that underscores just how interconnected global finance is, and it raises some serious questions about how large institutional investors navigate unpredictable markets. But here's where it gets controversial. Was this outcome simply bad luck, or are there deeper issues at play? The culprit behind this lackluster performance wasn't poor investment decisions or risky bets on volatile assets. Instead, it was something seemingly out of their control: the weakening US dollar. You might wonder why a pension fund would be so affected by currency movements, especially when its primary goal is to generate stable returns over time. Well, let me break it down for you. Many large pension funds, including Canada's biggest, invest heavily in international markets to diversify risk and tap into growth opportunities abroad. While this strategy can yield great results, it also exposes them to foreign exchange risks. When the value of the US dollar drops relative to other currencies, any gains made overseas lose some of their shine once converted back into Canadian dollars. And this is the part most people miss. The impact of currency fluctuations isn't always obvious until it shows up in annual reports like this one. For instance, imagine an investor who sees impressive stock market growth in Europe, but later realizes that those profits were partially wiped out because the euro weakened against their home currency. This scenario happens more often than you'd think, and it highlights the delicate balancing act that institutional investors must perform daily. So, what does this mean for everyday Canadians relying on these pensions? On the surface, a 1% return may seem disappointing, especially given the scale and resources of such a massive fund. However, it's important to remember that pensions are designed with long-term stability in mind, not short-term windfalls. A single year of modest returns doesn't necessarily spell disaster, particularly if the fund has built up strong reserves from previous years. Still, it's worth asking whether enough is being done to hedge against currency risks in an increasingly unpredictable economic climate. Now, here's where things get interesting. Some experts argue that pension funds should take a more aggressive stance toward hedging their portfolios against currency swings. Others believe that doing so could introduce new costs and complexities that might outweigh the benefits. Where do you stand on this debate? Should institutional investors prioritize protecting themselves from currency volatility, even if it means sacrificing potential upside? Or is it better to accept the occasional setback as part of a broader strategy focused on steady long-term growth? As we look ahead, one thing is clear: the challenges facing pension funds aren't going away anytime soon. With global economies becoming ever more intertwined, factors like currency shift will continue to shape investment outcomes in ways both expected and surprising. What steps should Canada's largest pension and others like it take to safeguard retiree savings while still pursuing meaningful returns? Share your thoughts in the comments below.